Zoom beat consensus for Q2 fiscal 2027. Revenue came in at $1.277 billion, edging past the $1.27 billion estimate, and adjusted EPS hit $1.55.
Which, cruised right past that $1.48 consensus.
Exactly. They even raised full-year fiscal 27 guidance across the board. I mean, revenue is now dialed up to between 5.085 and 5.095 billion.
Right, and EPS was bumped to a range of $6.08 to $0.12.
Yeah, but if you look at the tape, despite this double beat, the stock slipped to roughly 4% in after hours, trading to around $96.99.
Well, it is a textbook sell the news reaction.
Right, and definitely compounded by a Q3 revenue forecast that came in a bit on the conservative side.
For sure. So to figure out why the market is hitting the sell button on a company that's beating expectations, we really need to look under the hood and split Zoom's business down the middle.
Because they're essentially operating two very different companies right now, right?
Yeah, precisely. The enterprise revenue, their big corporate clients, that was the clear standout here. That segment grew 7.8% year over year to $787.5 million.
Oh, wow, 7.8%.
Yeah, it's actually their strongest growth rate in 3 years. Better yet, the net dollar expansion for those enterprise clients ticked up to 99%.
Meaning the big companies already using Zoom are steadily renewing and actually increasing their spending.
Exactly. But conversely, if you look at the online segment, which captures the everyday consumer and small business accounts, revenue was practically frozen at $489.7 million.
Which is, what, a microscopic 0.6% increase?
Yeah, basically flat.
Okay, let's unpack this. It feels like Zoom is essentially a tale of two cities right now. You have this booming enterprise AI suite, but it's tightly tethered to a legacy consumer app that just isn't growing anymore.
Right, because we aren't all hosting virtual happy hours anymore.
Exactly. And I have to imagine carrying that dead weight is hitting their profitability. I noticed their non-GAAP operating margin slipped to 40.0% this quarter.
Down from 41.3% last year. Yeah, that is exactly what is happening. What's fascinating here is how management's commentary showed they're essentially sprinting away from that old consumer identity.
So they're fully embracing the enterprise side.
Yeah, they're heavily focused on a complete transition into an AI-first system of action. They aren't just selling basic video calls to these corporate clients anymore.
They're selling automated workflows.
Exactly. And the underlying metrics show that this pivot is actually working. Zoom virtual agent customers surged 256% year over year.
Wait, really? 256%?
Yeah, it's massive. And their new My Notes AI feature, which basically acts as an automated assistant summarizing meetings and instantly extracting action items, that hit 1.5 million users in just 4 months.
That's incredibly fast adoption.
It is. And the real proof of concept here, paid AI was included in 9 of their top 10 customer experience deals this quarter.
I mean, I get that the enterprise clients are buying it and the features sound incredibly sticky, but I am struggling with the cost side of this equation.
Yeah, the margins.
Right. Are we just accepting that the margin compression we just saw is the unavoidable toll of the AI arms race? I mean, you can't build all these smart agents without massive server and compute costs.
Well, you really can't.
So is this just a permanent hit to their profitability?
Well, that is the multi-million-dollar question for you as an investor, and it brings us right to the notable risks buried in this report. Yes, there is intense structural margin pressure happening right now.
Because of these heavy AI infrastructure investments.
Right. Zoom is essentially rebuilding its engine mid-flight to support that enterprise transition, and that requires aggressive capital expenditure. Furthermore, management explicitly tempered their full-year online business outlook.
Which means they're officially guiding for flat growth there.
Yeah, due to what they call top-of-funnel weakness.
Meaning fewer everyday people are actually going to the website to sign up for fresh accounts.
Precisely. The organic consumer growth has plateaued. So the market right now is heavily weighing the massive capital expenditure required to build out these AI enterprise tools against the heavy anchor of that stagnant legacy online business.
Which leaves you with one last question to mull over. If enterprise clients continue adopting Zoom's AI tools at this rapid pace, transforming it from a simple video app into an essential enterprise workflow, how long will the broader public market stubbornly continue pricing the stock at a steep discount like a fading pandemic asset? Be sure to follow the show for daily earnings coverage.